Hi, I'm Allan Madan of Madan CPA. Today, I want to discuss an important and complex topic, the tax implications of leaving Canada permanently. Whether you're seeking better career opportunities, tax advantages, or a change in lifestyle, deciding to become a non-resident of Canada is a big decision that involves significant financial and legal considerations. This video is part one of a two-part series. In it, we'll cover the key concepts, definitions, and reasons people choose to leave Canada for tax purposes. In part two, we'll discuss the practical steps you need to take to make the transition. Each year, more Canadians decide to become non-residents. This trend has only grown following recent changes in the federal budget, particularly for high-income earners. Relocating to countries with lower taxes or better lifestyle options like the US or the Cayman Islands, is increasingly appealing. Some of the common reasons people choose to leave Canada are career development abroad, expanding a business internationally, tax advantages in low-tax jurisdictions, retirement in a warmer climate, lifestyle improvements, or family reunification. While those are some of the reasons to leave Canada permanently, one thing that we get a lot of questions about is, what about snowbirds? Snowbirds are those who choose to take advantage of the climate, typically in the US, during Canada's winter months, but don't wish to become US residents for tax purposes. I answer your questions about the tax obligations and timing considerations for snowbirds in my other video. Canadian snowbirds avoid these costly US tax mistakes, which is linked in the description below. Now that you know why someone might choose to leave Canada permanently, let's discuss the specific language the government uses to classify your residency status. Factual resident of Canada. You are a factual resident of Canada if you maintain at least one primary and/or multiple secondary ties to Canada. Primary ties include things like owning a home or having dependents in Canada. Secondary ties can be bank accounts, memberships, or a health card. You would be considered a factual resident if you are working temporarily abroad while retaining ties to Canada, communicating regularly between Canada and the United States for work, attending school outside Canada while maintaining residential ties, a government employee posted abroad, such as a member of the Canadian Forces, non-resident. If you sever your primary ties to Canada and have minimal secondary ties, and if there is no tax treaty with the country you move to, you will be considered a non-resident. This status means you are not subject to Canadian taxes on worldwide income. Emigrant. An emigrant is someone who leaves Canada, establishes a permanent home in another country, and severs most residential ties with Canada. As an emigrant, you are considered a non-resident for tax purposes. Deemed non-resident. A deemed non-resident still maintains some ties to Canada, but under a tax treaty, they are considered a non-resident for tax purposes. This occurs if you have significant ties in a country with which Canada has a tax treaty, and the treaty's tiebreaker rules classify you as a resident of that country. Becoming a non-resident or emigrant typically means you no longer wish to be classified as a factual or deemed resident of Canada. We've just outlined the definitions of residency status. Now, let's talk about how the government actually assesses your non-resident status. To assess your residency status, the Canadian government typically relies on Form NR73, Determination of Residency Status, or a self-declaration made through your final T1 tax return. However, we do not recommend completing Form NR73. Based on past experience, we found that this form often leads to complications. Since the evaluation and processing of Form NR73 is handled by a government official whose judgment and expertise may vary, there's a risk that your non-resident status may not be granted. Instead of using Form NR73, we suggest filing a departure tax return, your final T1, to declare your non-residency. This self-declaration effectively notifies the Canada Revenue Agency that you've taken the necessary steps to sever ties with Canada. While audits of non-resident claims are rare, they can be invasive. Now, let's say you've committed to leaving Canada permanently. Depending on your financial situation, you may have to pay a departure tax, also known as the exit tax. This applies to certain assets like foreign real estate, stocks and bonds, or other investments. If you keep these assets after you leave Canada, you will have to pay a departure tax. This is calculated as if you sold them at their fair market value on your departure date. As such, we recommend that you sell most of these assets, if you can, before you leave. We'll go into more detail on departure tax strategies in part 2. Knowing these definitions is just the beginning of the process. In the next video, we'll walk you through the specific steps to becoming a non-resident, including filing the right forms and handling your departure tax. Until then, if you're considering this move, consult a tax professional to get personalized advice. Proper planning will make all the difference in ensuring a smooth transition and avoiding an unexpected tax bill. Thanks for watching, and I'll see you in part 2.